Hi, I'm Matt McAleer, Executive Vice President and Director of Equity Strategies, joined by John Mousseau, President, CEO, and Director of Fixed Income at Cumberland Advisors here in Sarasota, Florida. Today we will be discussing our thoughts on the fourth quarter of 22 and how action in both the equity and fixed income markets affected the Cumberland strategies over this period. Let's get started with the broad overview. Ugly equity year in terms of 2022. Some areas better than others. Dow outperforming the S&P, which in turn outperformed the NASDAQ. Let's take a look at a couple of Cumberland equity strategies. We'll get started with the U.S. Core ETF strategy. Really benefited from an overweight in value this year. Had a very nice year versus its benchmark. And in terms of how we're allocated, that value piece along small, mid, and growth really performed well. In terms of our international portfolio, really in line with the benchmark. Some of the areas that worked well in the fourth quarter, believe it or not, were our European holdings. We see headlines daily about the headaches in Europe, both inflationary and with the war between Russia and Ukraine. But in terms of performance, Europe very strong in Q4. Emerging markets up a touch in Q4. We'll see if the dollar weakening helps the emerging markets coming into 2023. In active passive, that's a balanced strategy we run. We passively manage equities through the use of the S&P 500, SPY, and the Midcap 400, MDY. And in terms of performance, MDY this year, for the first time in about 7 years, John, outperformed the S&P. We blend those indices with individually managed bonds, where John manages the duration, and we look to create total return for our clients. In terms of performance, in line with the benchmark. In terms of what we think 23 may bring, it looks as if that mid-cap bid may remain for the time being. John, what about Q4 in the land of fixed income?
Well, I think you summed it up with the word ugly. It was certainly that type of year in 2022. A lot of culprits depending on the markets. Biggest culprit, Federal Reserve. They waited till the spring and started to raise short-term interest rates, 25 basis points at first, then 50, and then 4 75 basis point hikes in a row, for the last hike being 50 basis points in December. What did that mean? That mean short rates went up a lot, and that spooked longer bond yields higher. But not as much as short-term rates went up. So one thing that we've been battling for the last part of this year, and certainly from this quarter, has been a negative yield curve. And that's the difference between, a 2-year Treasury bond and a 10-year Treasury bond, which has gotten as wide as negative 80 basis points. It's a little less than that now. But what it says is investors are willing to accept less yield going further out than near term, which means they think the economy is slowing down and that longer rates are going to be coming down. By the way, we feel the same. For the quarter, it was really a tale of almost 3 different time periods. You saw the 10-year bond yield peak in October at around 425. Very big uptake, disappointment where CPI numbers, inflation was coming out, concern about the Fed continuing to be very hawkish in their language. And what happened? We got to the first week of November and we saw a good CPI number, less than expected on a month-over-month basis. And that was the first time in a while we had seen that. It turned the whole tenor of bond markets around, both munis and treasuries. We'll talk about munis in a minute, but it sent yields coming back down. That 10-year Treasury kept going down all the way down till it got to almost a 345. Right. That's a remarkable drop in a short period of time, basically from the end of October to the middle of December.
Yeah, who thought the equity markets are volatile when you get that kind of fixed income volatility?
Huge. And then I think more importantly, though, the last part of the year, the last 2 weeks of the year, saw that 10-year Treasury yield climb back to about a 3.88. So you come down basically 80 basis points, and you basically gave back 40 the other way.
Right.
What I think it meant, though, was that you really, for the first time all year, from a bond market standpoint, in the quarter, you took 2 steps forward and maybe 1 step back, where the rest of the year was either the reverse or 3 steps back. And what it really meant was, if you looked at the end of the year, it kind of reacted to what was going on in Japan, where they started to raise their rates up a little bit. And it was really just kind of a backing and filling of a market that had run so far. On the muni side, rates have gotten all the way up to over 5.25 for long-term, high-grade bonds, AA variety. When you start to do the taxable equivalent of that, it's amazing. You start talking now about 8, almost 9%, depending on what states you're in, taxable equivalent yields. People saw that, combining with those better CPI numbers, they went on to that. So those 5.25 numbers came all the way down to numbers between 4.25 and 4.5 by the end of December. Whereas Treasuries gave up a little bit at the end, munis really didn't give up very much, and the answer was simple. There wasn't as much supply this year as there was last year of new issue bonds. The supply this year came from, and we have a chart here, of bond fund liquidations, and they were the big boogeyman for the bond market.
Right.
And as you saw all of these issues placed on the market as bond funds got liquidations, it easily overwhelmed the market. And you can see on the chart the cumulative amount of those outflows, and we still don't have December's yet, is about $116 billion. We haven't managed money in a long time around here. We've never seen an outflow number like that. In our view, terrible, because it hurts current bond market prices. From an opportunity standpoint, absolutely one of the best bond market opportunities we've seen in yields, particularly compared to inflation. Because if you actually look at the other chart that we have, which shows what we call the break-even inflation rate, that is the market-derived rate of where the markets think inflation will be over the next 5 or 10 years. You can see those are down to around 2.5%. So you really, not from where trailing inflation has been, but from where the market thinks inflation is going, you had a very positive spread on bonds, both taxable and tax-free. And from a Cumberland management standpoint, keeping our durations longer than the benchmarks and pushing out to capture these higher yields, we think is helped in the fourth quarter and will help us going forward.
And clients look forward now to higher cash flow. Some of what you have to fight and take is that weakening in prices. But when you start locking in that cash flow for 5 and 10 and 15 years, that's tremendous.
It's tremendous, and people kind of lose sight of it a little bit. Let's say you own a 4% bond and yields back up to 4.5. So suddenly you're looking at a 90-cent price on it, and you go, oh, woe is me. Well, not oh, woe is me, because if you think about a long bond with a 4% coupon on it, over the course of 10 years, that's 40 points of income. Over 20 years, it's 80 points of income. Over the long run, it dwarfs any of this intertemporal movement on price.
Sure. Thanks, John. Let's get back over to equities. We have a quant strategy suite that we manage here at Cumberland. Just as a quick update, Market Vol and Lev Vol are our 2 primary quant strategies. They currently sit in cash and have for most of Q4. As a matter of fact, the last buy signal the quant series generated was back in the early spring. So it's been
a long time.
It's been quite a while. We also run a sector rotation strategy in the quant suite. Currently, since we are on a cash signal from our quant work, we sit in the defensive strategies. So in terms of where we sit right now, defensively in our quant work. We also have thematic strategies. U.S. Equity ETF being our largest thematic strategy, run by David Kotok. We continue to be overweight specific sectors in here. They are healthcare, aerospace and defense, and alternative energy. The fact that we can hold cash has been very helpful in this strategy this year, and similar to our U.S. core, has really outperformed the benchmark, which is nice to see. Now, just because we outperformed the benchmark doesn't mean clients were making money. So both strategies were down this year, but well ahead of the benchmark. Right. In terms of our final strategy, that's tactical trend. Tactical trend is interesting in that it can be in equities, fixed income, commodities, and cash. And for much of this year, it's held a 25 or 30% cash piece. Heading into 2023, three largest holdings, Berkshire Hathaway, Microsoft, and treasuries in the form of BIL, which is a short-term treasury ETF. When we add cash in, you're looking at 35, 36, 37% of the portfolio made up in those names. Fairly defensive. We'll look to see if commodities, which enjoyed a very strong first half of the year, can start to make a little rebound. They've been a touch weak recently. We have added to our energy position. We'll see about individual commodities into 2023. So we hope you enjoyed this video and look forward to providing you with more review content on the markets and Cumberland Advisors strategies. We do this on a quarterly basis. Feel free to reach out with any questions and make sure to visit our YouTube channel where you can find other relevant content, such as our week in review that John and I do. There are also strategy profiles housed there. Thank you.
Have a great new year.
We'll see you next quarter.